Good afternoon, ladies and gentlemen. It gives me an immense pleasure to talk about the changes made by the Finance Act 2022 relating to charitable or religious trusts or institutions. Let me at the outset, I thank the KSCAA and organizing committee of KSCAA for giving me an opportunity to share my thoughts on this to the August gathering and the allied members. You know, the Finance Act 2022 has made a substantial changes. 18 explanations has been inserted under section 1023C as well as section 11. And there are about 2 substitute provisos being added to section 1023C. A new provisos, 2 numbers has been added, and the substituted provisos were 3 in numbers, and the new subsection added relating to charitable trust is number 3. So total, if you put together, there are 28 amendments has taken place. If you look at the Finance Act, I think 50 to 60% constitute changes made relating to the provisions of charitable trust or institutions. And if you look at these changes, there are substantive changes, provisions has been brought in. And there are structural changes have been made. And there are provisions which they have brought a level playing between section 11 and 1023C. And some of the provisions causes hardship to the existing or the trust or institutions, particularly in respect of the cancellation of registration. Unwielded powers has been given to the principal commissioner or a commissioner of income tax on a matter which is already quite a number of litigations has been before the courts. And these are arising out of the judgmental factors. Even without undergoing the asset test before the appellate authorities, power has been given to the principal commissioner or commissioner to cancel the registration. First time in the history that you can see, penalty provision has been brought under section 271 AAE. And there are 2 types of penalty. The occurrence of the first time, occurring the first time, then occurrence subsequent times. On the first time, the penalty would be levied 100% of the benefit given to the specified person, not the taxes. Suppose you have paid a remuneration to all the trustees, say about 50 lakhs, by AO decides that they can be paid only 25 lakhs. On 25 lakhs will be treated as penalty, not the tax on 25 lakhs. So much of rigorous. Likewise, some of the provisions to set right, to negate the decisions of the various high courts, they have brought in. And very few where they have brought clarity to the concept and principles of taxation of charitable trust. This is just a bird's eye view of the changes made. Let me go into the specific changes made. The first changes made in the Finance Act is the voluntary contributions. The voluntary contribution given to the specified institutions governing under Section 80G2A have an option to treat the voluntary contribution at the discretionary or the option of the Board of Trustees to treat some of them as a corpus donation. So this option has been given to those institutions which are covered under Section 80G2A, consisting of temple, mosque, churches, Guru Nanaks, etc. So 80G2A is that those where the central government identifies and notifies in the official gazetting. Only those institutions, not all trust or institutions is entitled to this. You know, in 2021 Act, sweeping changes made with regard to corpus donation. Because the corpus donation, one of the principles underlying the corpus donation is that there must be a direction from the donor to the donee to hold it towards the corpus. So in 2021, law was amended that this corpus donation should be held, invested in a specified manner pursuant to 11(5) of the Income Tax Act. And there should be no dilution to this investment. And you have to prove, you have to maintain a separate, you have to prove the documentary evidence that this is invested in a manner under the Section 11(5). Suppose there is a dilution of this corpus donation, or those invested if you have not remained invested, then law deems that you have utilized or applied for the purposes of the activities of the trust. As a result, from the application, so much shortfall will be subtracted. That means your expense will come down. And now, those institutions covered under Section 80G2A, option has been given. Either you take it as a voluntary contribution, spend 85%, or partly you can hold it as a voluntary contribution, partly you can hold it as a corpus donation, even without the direction from the donor to the donee. This is an enabling provision which most of the institutions can create a corpus. This is the first amendment. The second amendment is with regard to accumulation of income. At one point of time, the institution covered under Section 23C had a wonderful privilege. Going back to the prior to 1998, Section 1022, Section 1022A was governing. That is in respect of educational institutions and hospital. If you satisfy that you exist philanthropic purposes or educational purposes, not for the purposes of the profit, then entire income were exempt. And in 1998, law was amended. They had to go on with various changes made thereon. And now, in case of section, this was the privilege enjoyed by Section 1023C. Suppose they have 10 crores of income, they have applied only 1 crore, again still 9 crore is exempt. Whereas in case of Section 11, you are bound to spend about 85%. You are obligated mandatorily to spend 85%. If you fail to spend it, either you have to accumulate and spend in subsequent years. There's no option for you. Or you have to pay the taxes. Whereas in Section 1023C, these provisions were not there. Now they have plugged it. They say what it would be applicable to Section 11 has to be undergone in case of 1023C. There is a provisos has been, the explanation has been added, where the educational or hospital institutions they have to spend 85%. If they do not spend 85%, then they have to undergo the procedure for accumulation of income as it would be applicable to Section 11 cases, and they have to file a prescribed form. And in the prescribed form, you have to specify the amount, specify the object for which you are accumulating, and then you have to specify the period that you would be applying this income. So this is a level playing between Section 1023 that they have brought in. So likewise, now you have been given an option under the cases covered under Section 1023C to accumulate the income. And you have to strictly follow the procedure laid down therein. And if you look at the procedure, you have to file the form number 10 within the prescribed time for due date for filing the return of income. And you are specifying the object, you have to apply the income for only those objects. And timeline has been provided. Suppose you do not comply with the requirement of the procedures or the proviso of under 23C as applicable for accumulation of income, the consequences are determined. The reasons, circumstances is if you apply the income subsequently other than the object that you have accumulated, or you have not invested or ceased to remain invested in the prescribed amount under Section 11(5), then in such circumstances, exemption will not be available. Then again, if it is not utilized for the purpose for you have accumulated the income, something other than those objects, then you will not get the benefit. And from the accumulated income, if you give away as a donation to the institutions covered under Section 12AA or 12AB, you are not entitled for an exemption. And now first time again another level playing have been brought in. In case of Section 11, Section 11 only talks about the income derived from the property held under trust have to be applied wholly for charitable religious purpose in India, because the tenor of the language used in Section 11(1)(a) is very abundantly clear that you have to apply the income in India. Whereas in case of Section 1023C, for example, the education or hospital, there is no specification that you have to apply the income in India. Suppose you set up another institutions outside India, if you apply the income outside India, there was no limitations covered under the statutory requirement. Now this again level playing has been brought in. Even those institutions covered under Section 1023C, they have to apply the income in India law. Then we'll come back to the next level playing, changes made under the Act, changes in the objects. So I was reiterating that you have to file for an accumulation, because now it applies again Section 11 as good as Section 1023C. In case of Section 11, there was a built-in provision when you specify the object in form number 10 for accumulating the income. Subsequently, Board of Trustees finds that it is difficult to apply the income for those objects which they specified. A flexibility has been brought in Section 11(3)(a). So 11(3)(a) was a governing where you can give a notice to the assessing officer saying that we may not be able to apply the income on those objects, but we would like to apply the income for the following object. You can bring it to the notice of the assessing officer. Whether assessing officer replies or not is immaterial, as long as those objects covered within the constitution of trust objects, it would enough. Now in case of 1023C also, level playing has been brought in. Those accumulated objects can be flexibly changed by giving a notice to the assessing officer. So similar what it was contained in Section 11. Now, another significant change is with regard to the maintenance of the books of account. In case of charitable trust or institution, are there any prescription that you have to maintain the books of account? Under which provision? Law is silent. And what are the books to be maintained? Because one institution can maintain one book, The other institution maybe there is no uniformity. In fact, those who have reference to our book on practical approach to taxation and accounting of charitable trust, in the very first edition we have brought in chapter 47 about the issues with regard to the maintenance of the books of account. And now the law has been amended, both under section 1023C as well as in section 12A governing. The CBDT will prescribe the books of account that you have to maintain. And not only just they prescribe, they will prescribe what are the other documents that you have to maintain. And not only the other document, they will also specify where you have to place, you have to maintain the books of account. So those institutions where they have an income before giving effect to section 11 and 12, if the income far exceeds the maximum amount not chargeable to tax, then they have to maintain compulsorily the books of account and audit also. Whereas if you refer to section 44AA, which talks about maintenance of the books of account, it talks about profits and gains of business or a profession. And those charitable trusts which does not involve in any business, then there is no requirement to maintain the books of account. And now this has been taken care of. The CBDT will come back and prescribe what are the books, what are the documents, and where you have to maintain this. Similarly, in case of audit also, now it has been made mandatory requirement. Even in case of section 1023, provisos were prevailing, and now they have made it mandatory requirement that audit has to be done when the income far exceeds the maximum amount not chargeable to tax, and audit report filing the return of income and uploading the audit report is simultaneous before the due date for filing the return of income. Before filing the return of income. So this is one part. Let me go to the other most controversial issues amendment made. That is cancellation of registration. The cancellation of, at one point of time, charitable or religious trust, once the registration granted under section 12A, it was infinite. There was no cancellation at all. Exemption may not be given, but cancellation cannot happen. In 98, they brought changes under circumstances like when your institution is not genuine, or when you are not carrying in activities in accordance with the deed of trust or a bylaws, then under that circumstances, cancellation can be made. Again, this has been further amended in 2010, 2014, and now 2019 made another sweeping changes with regard to cancellation of registration. 2020 they made a changes. In 2022 Finance Act, they have substituted bringing all this in one forum. There are three limbs attached to the cancellation of registration. The first limb, when there is an occurrence of the specified violation, on the basis of the specified violation, power is vested with the principal commissioner or commissioner of income tax to cancel the registration. Let me tell you later what are those specified violations. The second limb relates to when the principal commissioner or a commissioner of income tax receives a reference from the assessing officer under second proviso to section 143, on the basis of his reference, principal commissioner or commissioner of income tax can give you a notice and can give you a show cause notice as to why your registration cannot be cancelled. This is the most dangerous one. What does the second proviso of section 143 says? Suppose your trusted institutions engages in a business, profits and gains of business, Sometimes profits and gains of business where first proviso to section 215 applies. In such circumstances, assessing officer will not pass the assessment order. He will make a reference to the commissioner, and commissioner will assume to look at it, and then he will first cancel the registration. The moment the cancellation of registration, your exemption will go away and 115 TD provision will apply. This is the most difficult situation that we have. Because to say whether I have engaged in a business or whether I have engaged in an incidental business, whether I have engaged in incidental to the attainment of main object it is a most important aspect, and it depends on elaborate discussions. When the first proviso to section 215 came in by the Finance Act 2008, in the course of the implementation of this provision, or even in the course of the discussion before the Parliament, then Finance Minister was assured to both the houses of the Parliament, saying that genuine institutions will not be made, or genuine institution will not suffer on account of these changes. But in practice, genuine institutions were put to hardship, because the clarity on the understanding of the business, trade, commerce, or rendering of the services in the nature of business, trade, commerce went wrong. And quite a number of litigations cropped up. When the litigation cropped up, at least 90% of the overwhelming majority of the tribunal and the high courts have come to the conclusion that first proviso to section 215 in most of the cases will not apply. This was held at the tribunal stage. And now, just merely but AO passes a reference to the principal commissioner or the commissioner, and then the commissioner will take a cognizance of this without undergoing the appellate authorities and cancel the registration, which route itself will be cut in this. So therefore, you should be very careful when the business is engaged. Because thankfully, the first proviso will apply only when you have an advancement of general public utility object. In the pursuit of the achievement of this object, if you engage in trade, business, commerce, or rendering of service will apply. But there is no deterrent for you not carrying any business. Because there are two important provisions. First of all, when the first proviso will apply is a big question. Because in our book, we have clearly devoted sufficient time making the research in understanding the subject when first proviso will apply. The reason is this. There is no limitation for a charitable trust to carry on business. They can carry on business, but it should be incidental to the attainment of the main object. Because law governs it. There's section 11(4)(a) governs in this regard. It says that you can carry on business, but it should be incidental to the attainment of main object. And secondly, you have to maintain the separate books of account. As long as you satisfy these conditions, whatever the surplus generated out of this business can be brought back to charity, and you are entitled to claim an exemption. There are no limitations. So when there is a right for me to carry on the business, which are incidental, where section 11(4)(a) will apply, when the first proviso will apply, the first proviso will apply only when you have an exclusive intention to carry on a business. To say you have intention to carry on a business is not just easy. First, do you have a profit? You have intention for profit? Point one. Because without an intention for profit, where is the business? So quite a number of issues to be looked into. I think we have factored at least 12 factors have to be examined to say whether I have engaged in the business or not. And now power is vested with the principal commissioner. Easily that they will give you show cause, cancel the registration. And the third limb of this cancellation is with regard to risk management strategy. What is risk management strategy? We don't know. Probably that we will hear in the near future from the CBDT. If your case comes under the risk management strategy, based on which cancellation can be made. What a pathetic situation that we are today. Whether you did a violation, no. Just because they have highlighted the parameters for the risk management strategy, under this risk management strategy, if you fall under that, then power is vested with the commissioner to cancel your registration. So now let me come back to what is the meaning of specified violation. The specified violation now first, when the application of income for other than the objects, that means you have a constitution of trust or a bylaws of society or the memorandum. You have an objects. Did you apply the income for those objects? Yes or no? If no, then it can be considered that you have applied the income other than the object. Whether you have applied the income to the extent of 5%, 10%, 20%, 50%, immaterial. As long as you apply the income for other than the objects, then it falls within the limb of the specified violation. That means strictly you should go with the conduct of the objects and spending the money only to those objects. Even if there is a slight divergence of the spending, you may land in specified violation. So when you talk about the application, you must see that application, whether you applied for education, whether you applied for education, hospital, or any of those 6 limbs, you have to see that. You have to segregate this expenditure application to the 6, and you must be safeguarding yourself. The second is profits and gains of business. I have already reiterated. Just because you have a profits and gains of business, not incidental to the attainment of main object. That means wherever section 11(4)(a) applies, power is not vested with the commissioner. Other than 11(4)(a), if you engage in business, power vests with the principal commissioner, CIT, to cancel the registration because it falls in the limb of specified violation. Then, activity. Suppose you carry an activity which is not G9, or you carry an activity not being in accordance with the constitution of your trust. So this is the base which falls in the limb of specified violation. What is not G9? Not defined under the Income Tax Act. G9, is it mean that it is a spurious? Under the General Classes Act, it talks about when it is opposed to the public policy, opposed to the public, it assumes the character of not G9. And there is a judgment of the Madras High Court in dealing with the partnership. It says that when it is opposed to the public, when it is opposed to the public, morally, if you carry an activity, that is not a G9 one. Again, when you have when you carry not in accordance with the condition for the registration is granted. See now, at the time of registration, you provide the documents to the commissioner to grant the registration. Now under section 12(a)(b). And strictly you have to follow what you have given to them. Suppose there is a divergence of what you have given them, what you have carried out. It is because it says the condition they have provided. That means whatever the condition for which he has granted the registration, you must look at it, and you have to carry an activity accordingly. If there is any divergence to that conditions, it falls under the specified violation. Then, another most dangerous thing is with regard to not complying any other law for the time being in force. First in the history in 2019, this law was brought in. We don't know under which of the laws would be applicable to us. Whether the Provident Fund Act, if you violate, will you fall under this? professional tax violation, will you fall under this? Without the act? Because they say that not complying any other law for the time being in force for attaining the objects of the trust or institution which are reached either by decree of the court order or an order which has reached the finality. That means it has reached the ultimate stage where you are not disputed. If you are simply pay the penalty and accept that mistake means that you will lose it. It is strictly not following within the meaning of not complying on law for the time being. Basically, I look at it. The law which you apply is those for achieving the objects. To my mind, thinking is, loud thinking is, suppose you are registered under the Societies Act, where you have not complied, where the registrar says that you have to wind up this society for not complying the various things, then it goes to the root of the society. Therefore, under those circumstances, it falls within this cancellation can be made. And under the FCRA, Foreign Contribution Regulation Act, if under the Foreign Contribution Regulation Act, if the cancellation of registration is done, where the foreign funds will be stopped, which goes to the root of your achieving the object of the trust, for which registration can be cancelled. See, whether I have violated the foreign contribution where they have cancelled the registration, but I have a local funds, why registration to be cancelled? Because there are two limbs. One is either because of the privilege that the foreign funding you will register under the FCRA Act and you will receive the money from the foreign donors. At the same time, you have the local fund where you generate the local voluntary contributions. If you have violated under FCRA, okay, don't give me privilege, but don't cancel my registration because I have a local fund which I am carrying on my genuine activities. And also, the Foreign Contribution Regulation Act, when there is a violation, when this cancellation, 3 years you cannot apply. 3 years you cannot apply. As a result, it gives the power for the commissioner to cancel the registration. Because now the data is easily accessible by all the departments together. Either the FCRA can access your income tax can access to FCRA. So now, whenever there is a violation, under the FCRA Act, there are about 7,500 institutions not filed the annual returns of December 2020. That is March 2020. Because on the 29th of September 2020, law was amended, where all the institutions registered under the prior permission of the FCRA, they have to open an account with State Bank of India, New Delhi only. And they also said, you can approach the local banker of State Bank of India, they will assist you. By the time the local bank understood the principles of opening the bank account, it was January 2021. And they were asking so many documents and all that. Most of them, there was a mishap, they could not open. And ultimatum was given by 30th of June 2021, annual return has to be filed. And many institutions, they did not file. On the 1st of July, if you open the portal, it says that based on the contribution, you have to pay penalty of 5%. Suppose you have 10 crores foreign contribution, 50 lakhs penalty to be paid. Unless you pay the penalty, you cannot upload the annual return. Now, they will wait for 3 months, they will wait for 6 months, and later on, it will go to the cancellation of registration. Automatic. Just because you have not filed the annual return, your registration is cancelled. Unfortunately, you will lose the registration under the income tax also. This is the position. Then, the other changes is with regard to the second limb. I would like to discuss more on that. the second limb of the cancellation, that power given to the principal commissioner or the commissioner of income tax to cancel the registration on a reference by the AO pursuant to second proviso to section 143.3. See, 143.3 second proviso talks about first proviso to section 250. So whenever this proviso applies, he will not pass the order. He will make a reference to principal commissioner in case of trust, saying that he has to take a cognizance and he has to pass the order within 6 months. Limitation has been brought in. So he will give you show cause why your registration should not be cancelled, because you are engaged in trade, business, commerce. You may say, no sir, this is incidental to the attainment of my main object. Not section 11(4)(a) will apply, but this is an incidental, because what is incidental is difficult to define. When I say it is only incidental, sir, it is not my business. I am not intending to do business. Notwithstanding what you say, cancellation of registration may follow. This is the most dangerous, especially those who have advancement of general public utility. And similar provisions have been brought into section 1023C also. Where we need to seek more clarification with regard to the way forward. And the third circumstance, as I said, risk management strategy. Nobody knows what is the risk management strategy. Who defines the risk management strategy? Whether the trust will define, or the government will define, or the Central Board of Direct Taxes will define. So if your case falls under the risk management strategy, you are finished. Cancellation of registration will follow, sooner or later. So these are the cancellation provisions which have been changed at the financial. Now let me go to the other changes. Changes made by the finance, the furnishing of return of income. Now, section 11, as far as section 11 is concerned, the law was amended in 2015 by the Finance Act 2015. The filing of return of income is a mandatory requirement unless the return of income is filed within the prescribed date. Accumulation of income benefit will not apply. And in 2017, law was again amended, bringing a provision in section 12A, small ba of the Income Tax Act, because 12A is a governing provision, primary condition. Maintenance of accounts, audit, filing of return of income is a primary condition. If you do not satisfy this primary condition, exemption will not be available. So now it says that furnishing, even for 1023 cases, they brought a mandatory requirement. Filing of the return of income is a must, without which exemption will not be allowed. Then, see, in case of section 11, when you provide a benefit to persons specified in section 13(3), 13 within brackets 3, that means there is a violation, and the violations are covered under section 13 of the Income Tax Act. If you look at the section 13, you have two limbs, section 13(1)(a) to 13(1)(d), section 13(2)(a) to section 13(2)(h). These are the two limbs of that. Section 13(1)(a), 1(b), and 1(c), 1(d), and 13(1)(c), when the income or the property of the trust or institution is applied for the specified person, then forfeiture of exemption can happen, because in section 11 and 12 says, whenever section 13 applies, 11 and 12 will not apply. That means you will not get the benefit of exemption at all. Whereas in case of section 1023C, even if there is a specified benefit to section 13(3), there is no rider condition for losing the exemption. Because in case of section 1023C, section 13 have no application, because there is no reference here. Because there is a judgment of the Mumbai High Court also which says that for 1023 cases, section 13 will not apply. Now they have brought in a changes. Whenever Section 13 applies, whenever there is a benefit to the specified person under Section 13(3), even in case of Section 1023C, it applies, and as a result, you will lose the exemption. Then come back to the next, the income chargeable to income tax. I will take it in the next slide, discuss more. And earlier in 2020, in 2018, Finance Act amendment has been resubstituted in 2022. That means TDS and then cash expenses, non-deduction of TDS and all that will apply. Just like a case of profits and gains of business or a profession, as it would apply, same thing will apply in case of charitable trust or institution. The another far-reaching impact of the amendment is only in case of expenses, that is called application. The application is allowed only when you actually pay the sum. That means you may follow accrual system of accounting. It is not recognized. What is actually sum paid? That means there should be movement of funds from your bank account to the recipient. Only when you can prove the money has moved from you and received by the other recipient, then only that it is said actually paid. Because if they said sum paid, the writing of check would have been enough. But they said actually paid. So you have to satisfy the test that you have actually paid. That means movement of funds. You have to prove the evidence of movement of funds. So whether you follow accrual system based on the crystallization of the liability, where you are recognizing in your books of account, showing as a sundry creditors payable, has been given go by now, purely on the basis of receipts and payments. What you have paid. So then those who are following the accrual system, how do they do that? And onerous lies with the chartered accountants who are signing, auditors who are signing the 10B report. Because there should be no mix of this. In fact, in our book we have suggested that as of 1st April 2022, you crystallize what is the opening balance of the sundry creditors. Crystallize it. And whatever the payments made for the opening sundry creditor, you subtract at a glance. Then you know the balance of sundry creditors relating to the earlier years. Then come back to the fiscal year 22-23, whatever the sundry creditors you show separately. What it helps you? It helps you when you are computing the income, these sundry creditor balances shown for 22-23, straight away you subtract while computing the income. So you subtract from the application, then the remaining is the total sum actually paid. This is how you can easily do this. I think maintenance of books of account I have already dealt with. Now I will come back to income chargeable to tax. Suppose there is any violation, law says you have to compute an income in a specific manner. Of course, I welcome this amendment. Because at one point of time, whenever there is a violation, based on the violation, the entire income was forfeited. On the gross income, department was canvassing on the gross income tax to be levied. Suppose you have a 10 crores of gross income, net surplus is only 50 lakhs. In case of any violation, they used to tax on the 10 crores. First time in the history that Mumbai High Court came in Sheikh Mafatlal case, they said, when the institution carries genuine activities, charitable activities, you can't tax them on this. Only to the extent of violation you tax them. Then came by the Karnataka High Court decision in CIT versus Fox-Muller's case, where they said to the extent of violation you have to tax it. Again the Madras. So overwhelming majority of the court says you have to tax to the extent of violation, but you cannot tax on the gross income. Now the law is amended. In line of those decisions of the court, they say the income will be taken as you have reported in the income and expenditure account, and they will not allow capital expenditure, and they will not allow expenses incurred out of the corpus funds, and they will not allow expenses incurred out of the loan borrowed, and they will not allow any donation that you have paid, and they will not allow depreciation, where you have already claimed as on the acquisition of asset as an application. Those cases will have. I think here the clarity that they have brought in. This is the welcoming changes that Finance Act done. Now you know where you stand. There's a violation, you yourself can compute. This is the way forward of that. Then, I think time is running, I believe. 115 TD, I think, similar what it was contained, have been newly substituted, but substance of the provision, what it was contained in the earlier, remains the same. And here 115 TD and cancellation of registration, you have to refer to the tribunal decisions of Ratan Tata Trust versus the Principal Commissioner of Income Tax. The Ratan Tata Trust and Principal Commissioner, in that case, because Tata Sons hold shares in the various of their entities. Because holding shares in the various institutions, holding the share itself is a violation under section 11.5, read with section 13.1t. They know. Therefore, on the 15th of March 2015, they wrote a letter to the Commissioner of Income Tax on suo motu, cancel my registration. So department would have welcomed and they should have cancelled it. But the commissioner said, I don't have power to cancel the registration on your behalf. Only I must find that there is a violation, some condition, then only I will cancel. Therefore, he has not cancelled. In 2019, he took up, because law was amended in 2018, by virtue of this act, he took cognizance for cancellation of registration. The moment he cancelled the registration, he invoked 115 TD, because law was amended in 2018, which was applicable for the assessment year 18, 19 and onwards. This was challenged, and the Mumbai Tribunal said, you ought to have a cognizance of 15th March 2015 and not now. Therefore, cancellation, when the assessee comes forward cancellation, you should act swiftly on the basis of that and not on your own. So now let me take, I have only 5 minutes left with me. The penalty provisions. 271 AAE is the most dangerous provision, let me assure you. Because so far we have not seen any penalty in case of charitable trust. Even violation, either exemption will not be there or fight out in the tribunal. All that. But now, you had to pay penalty. There are two types of penalty. Penalty for the first time, penalty for the second and subsequent. The quantum of penalty for the first time is 100%. 100% of the benefit given to the specified person. Suppose you paid a salary of 50 lakhs. AO says 25 lakhs only he deserves. Then 25 lakhs you will challenge. But penalty provision will be invoked and you have to pay 25 lakhs as a penalty. It is not the tax and the penalty. Tax, what you have forgone, is not the levy. What is the benefit given to the specified person is the penalty. And in case of the subsequent violation, 100% have been hijacked to 200%. Instead of 25 lakhs, suppose you paid 50 lakhs, he allowed 25. Again, second year, you paid 50 lakhs, but 25 lakhs only he allows. That means you have to pay 200% of 25 lakh. That is 50 lakh. See, by the time the assessment happens, you would have elapsed 2 years. Therefore, this is a concurrence of violations. So friends, these are the few thinking, but now the limitation of time, FCRA, I may not touch upon that because I have been given a mandate to close. I am closing now. I thank you all of you. If you have any questions on FCRA on this, I welcome it. I will address those issues, please. Thanks all of you for this. Thank you.
Dear members, due to time constraint, any questions by the delegates can be taken up offline. Thank you, sir, for enlightening us with the recent amendments relating to trust and charitable institutions and for letting us know about the major non-compliances which can be seen as red flags. I now request CA Pradeep Jogi, EC member, to present our speaker with a memento.
It was a live caricature which was done while the speaker was presenting. We thank you, sir.